Everyone, this afternoon let's look at IAS 37 titled Provisions, Contingent Liabilities and Contingent Assets. This is perhaps one of the most robust accounting standards in financial reporting and corporate reporting. And in case you are coming across our channel for the first time and you'd like to join us, kindly call us or chat us on 081 41 83 8062. We also run an online class for ICANN, ACCA, CITN and ANA. Thank you very much. Now, provisions, contingent liabilities and contingent assets. There are three things here. Provisions, number 1. 2. Contingent liabilities. 3. Contingent asset. So those are the three aspects that IAS 37 covers. But I am going to start with this afternoon with the first part, provision. When we say provision, okay, it is not the milk, the Milo and others. No. Provision in accounting, what does it mean? Say, provision is a liability of uncertain timing. Uncertain timing or amount, that is, you are owing and you don't know when to pay, and the actual amount you are likely to pay. So it is a liability of uncertain timing and amount. Provision has an element of uncertainty as to the amount or timing. That is, provision has two legs. Okay, 1, it deals with the amount or time, and the amount you are to pay is not fully known, and the time of payment too. Okay, so that is why it is called uncertain timing or amount. Now, liability on the other hand is a present obligation, okay, as a result of past events, settlement of which will result in an outflow of economic resources. That is, liability is an obligation which arises due to the past events, the past transactions you have entered into, okay, which will result in an outflow of an economic resources. So now, provisions should be recognized. If the criteria are met, you will be asked that on what condition or what are the criteria for recognizing provision. According to IAS 7, an entity should recognize provision when 1. There is a present obligation as a result of past event. That is, there is an obligation on you now due to the past event, and the obligation could either be legal obligation or constructive. Now, the obligation is legal, okay, if the terms of the contract, okay, or the law puts it on you. For instance, I have come to, okay, lease your land, right, where I am going to put my assets. And you say that, okay, Mr. Man, at the end of the years, okay, of agreement, the 10 years, that I should help you repair your land and restore the land to the way it was. Now, in this case now, there is an obligation on me because the terms of the contract put it on me and I accepted it. So I have an obligation. Now, it could be constructive, okay, if by your character or by your policy, okay, you have made it known to the public that, okay, our company, anywhere we go to install an asset, that after the years we always repair, restore the place back, and then by so everyone, okay, has an expectation that, oh, if this company lease land from us, they are going to help us restore the land back. Or also, maybe you have also put it on your website that, oh, ABC Limited is an environmental friendly company. That is, you always do repairs, okay, of the land after the end of the contract. 2, it must be what? Probable that the obligation will result into an outflow of economic resources. That is, it must be certain that this obligation will require you to transfer economic resources. Third, now, the amount involved can be measured reliably. That is that. Now, provisions under IAS 37 are many, but for the sake of understanding, okay, we now decided to group it into two. Next, now, broad classification of provision. Provisions can be broadly, okay, grouped into 2. 1, asset related provision. 2, non-asset related provision. That is, we can say asset related provisions. 2, non-asset related provision. How then? And when you say asset, okay, these are the provisions, okay, that has to do with the asset, with the non-current asset of the company. What are the examples there? Here we have the commissioning cost. How then? 2, environmental cost. 3, landscaping cost. These are the 3 common examples of asset related provisions. Next now, non-asset now. What are they? 1, warranty. 2, onerous contract. 3, restructuring. 4, court case. There are many more. So these provisions do not relate to asset. How then? Next now, measurement of provisions. How then? Remember that under the conceptual framework, okay, we talk about about the measurement. Measurement, okay, normally is the act of determining the monetary amount, okay, to be placed on the element of financial statements, e.g., assets, liability, equity, income, and expenses. And what we have here is liability. Now, how do you measure provision? How can we ask you this, okay? Explain the measurement of provision. Now, IAS 37 requires that provision should be measured based on management best estimate of the expenditure. That is, the management should decide, okay, using their IQ, okay, based on their best estimate of the expenditure. That is the amount, okay, required to settle the present obligation. Now, the estimate should take into consideration the historical information, present information, and future expected estimate. So the management, okay, should look at what happened in the past when they had similar case, okay. How much do they provide, and then compare with what they have as their present information. So that is how to work to determine the amount to be provided for. Now, time value of money. Sometimes, okay, provision, especially such that relate to asset, like the commissioning cost and environmental cost, okay, could take years. Could take years. Now, because it takes years now, and it takes a long time, the time value of money becomes relevant. Now, IAS 37, okay, requires that provision should take into consideration the time value of money. That is, if the time value of money is material, maybe it will take 10 years, okay, 20 years, okay, to do that provision. That is a whole time. Definitely, in this case, okay, the time value of money is material. However, in the question too, you'll be told, so provision should be discounted. The unwinding cost should be calculated and be treated as a finance cost in the P&L of the year, and the unwinding cost should be used to increase the provision at the year end in the SOFP. What are we saying here? Okay, to discount the amount you are to provided for, right? Once that is done, you will use this word formula, okay, to do that, to get the present value of the future amount you are to provided for. The FA here is the future amount, okay, or the future value, the amount you are to provided for. The R here is the discount factor, the discount rate, the cost of capital. The N here is the number of year. So you will just insert, okay, and get the PV, the present value of the provision. So that is that. Next now, asset. Next now, okay. Once you have gotten that now, okay, you have taken into account how to do your provisions, measurements, and time value of money, especially if they are asset related provision. Next now, how should we account for provision? Yes, you have to be very careful in the exam to understand that is it an asset related provision or not? So if it is now, right, now, the PV of the provision should be calculated and be included in the initial measurement of the asset. What are we saying here? If it's an asset related provision, IAS 37 says that calculate the future PV, okay, of the amount. So once you get that now, okay, add it to the what? To the value of the asset, right? Yes, because it will increase the value of the asset. So add it to it, and also what? Credit what? Provision, and it will appear in your SOFP as a liability. And at the end of that year now, okay, what is the unwinding cost? That is the interest or the finance charges. You will get your unwinding cost too, okay, based on the present value of the liability or the provision. So once you get the unwinding cost, okay, take it to P or head of that year as an expense, okay. Also, go to your SOFP at the end of that year, add it to the initial amount of the provision, because the essence of the unwinding cost is to increase the provision at the end of each year. So next now, for non-asset related provision, of course, these are provisions that do not relate to assets. Now, how are you going to do their accounting? Upon initial recognition, that is for the first time, okay, estimate the amount of the provision. So debit your P or L, okay, as expense, and in your SOFP as liability. Now, at the end of the year, if the closing provision, okay, is greater than what you have at the beginning, okay, then the increase now, which is the difference between the closing year end provision and the one you got before. Okay, find the what? Find the increase, the difference. That will what? Also appear in the PO head. In the PO head as an expense, and what? Also add the increase to the initial provision in the liability. So this is the note now on the IAS 37. Out there, provisions, contingent liabilities, and contingent assets. So very soon we are going to take a look at some of the asset related provision, especially on the commissioning cost and environmental cost. See you next. Pause. Okay, now so let's take an example now from our material on the platform. Okay, question 1. Out there. Okay, question 1. That one asks 1A and 1B. So the 1A talks about what is liability, and then what are the criteria or condition for what? Recognizing liability and its measurement. All that we can do by ourselves. So let's go to 1B now. That 1B, out there. On 4th October 2007, Pathfinder, okay, 1B is on Pathfinder. Out there. Pathfinder. So Pathfinder Limited acquired a newly constructed oil platform at a cost of 30 million naira, together with the right to extract oil from an offshore oil field under a government license. The terms of the license are that Pathfinder will have to remove the platform. That is what? A legal obligation. We have to remove the platform and restore the seabed to an environmentally satisfactory condition in 10 years' time, when the oil reserves have been exhausted. From this case now, okay, we can see that what? There is a legal obligation, right? So the estimated cost on this, okay, of this now on 30th September 2017 is what? 15 million. That is the cost, okay, to be incurred to remove the asset and restore back that place in what? In 10 years' time, as at today now, is 15 million. The present value of 1 naira receivable in 10 years' time and the appropriate discount rate for Pathfinder is 8% or 0.46 kobo. That is either 8% or 0.46 kobo is the 1 naira in 10 years' time. Now, required. Explain. BI now. Explain and quantify how the oil platform should be treated in the financial statement of Pathfinder for the year ended 30th September 2008. This is BI. Now, BI says, okay, that what we should explain and quantify. What are you explaining? Anytime you are dealing with a standard and says explain and quantify, okay, by what? By that word quantify, calculate and show the figures in the financial statement extract. But explain. Now, in this case now, there is a present obligation, right? A legal obligation on Pathfinder that come, Mr. Manu, hear us well. After 10 years' time, you are going to remove the asset and help us restore the seabed back to the way it was when you came in. And Pathfinder did not object, he agreed. So there is an obligation. 2, the amount to be used, okay, to do that thing in 10 years time is what? 50 million. How then? So now let's see now, okay, how to explain. According to IAS 37, there is a present obligation on Pathfinder Limited to restore the seabed to an environmentally satisfactory condition. Yes, that was the term of the license contract, and he agreed. He didn't object, so he has an obligation. Thus, the present value of the future environmental cost should be determined. That is, you are to what? You are to determine the present value of the 15 million now in 10 years time by using this formula, and be added to the initial measurement of the asset. What are we saying? This is an asset related provision. Now, IAS 16, okay, says that determine the PV of the cost to be incurred in the future and add it now to the initial cost of the asset to know the total capitalized cost of the asset. So you are going to determine the present value, okay, in 10 years time now, and whatever you get, you will add to the cost of construction, okay, to get the total cost. Also, unwinding cost should be calculated and be treated as finance cost in the P&L. Meaning what? You are what? Going to what? Calculate unwinding cost or interest. You will charge interest, okay, based on the PV every year, and that interest will stand as a finance cost in the P&L, and also be added to the PV of the provision in the SOFP to determine the closing value of the provision in the SOFP. What are we saying? Calm down. Now, once I get the PV of that 15 million to be used in 15 years time, I will calculate my unwinding cost too on it as interest. So take it to what? To the P&L, okay, as finance cost. At the end of the year too, what will be the closing provision? Okay, it is the PV I got plus the unwinding cost. Shaking now, out there. Also, the initial cost of the asset should be depreciated based on the estimated useful life of the asset, and the depreciation should be recognized as an expense in the P&L and also be deducted from the initial cost of the asset in the SOFP to determine the carrying value. Once you get the total cost of the asset, are we there? What is your depreciation? Exactly. Then take it to your P&L in that year as an expense. Also in your SOFP, okay, take it from what? From the total cost of the asset. Out there. So let's see now. The financial statement now. Cameraman, please. Extract. Here I will do two now. Okay, income statement for the year ended 30th what? September 2018. Out there. 18. I think in 1,000. Yeah. 2. Statement of financial position as at 30th Here you have non-current asset. Here you have non-current out there. Pause. So now let's now the financial statement extract. Workings now. Workings. Out there. The first thing to do out there is to what? Is to determine the what? The PV, the determination of present value of the future environmental cost of seabed restoration out there. Now to get the PV, the PV equals to the future value bracket 1 plus Rn. Now the FV is that future value that you are to use. That amount, that amount, right, you want to spend in 10 years time is how much there? Is what? It's not 15 million out there. So the R is what? 8%. What is the N? 10 years out there. But because already I have been given the present value of 1 naira, hear me now, in 10 years time, definitely I am what? Not going to use this one. Yes, because the PV of 1 naira in 10 years time has been given, so I won't use this. Had it been I don't have that, I would have used this formula. Let's now. So therefore the PV now, equals to the 15 million, right, times what is 0.6 naira, right? So that is what 6.9. Now this is what the PV of the cost of restoration. Now the PV, that's what that you are going to add to the cost of the asset to determine the initial cost of the asset. So please, let's go there. Remember? Although now had it been we don't have the PV of the 1 naira, I would have used this formula. My PV equals to the FA 1 plus R, the PV is what? The 15 million, the FA is what? 15 million 1 plus what? 0.08, now what? 10 years. That will be the 15 million 1.08 over 10, right? You will see what? You will see have what? 6.9 out there. 6.9. But you have to follow examiner's instruction, because you have been what? Given what? The PV of 1 naira in what? 10 years time as 0.46 kobo. So you have to use this. So I only showed you this in case you are not given the PV of 1 naira. Use that, So after this now, right? Ask yourself, what is my unwinding cost? My unwinding cost, Your unwinding cost, that is what? The interest Now, your unwinding cost is very easy because what? The PV, okay, of what you got here times what? The discount what? Factor. So what is the PV now? 6.9 times what? 8%. That is what? Our unwinding cost. Our what? Our unwinding cost as what? 552,000. Third now, initial cost of what? Third now is what? The initial see as I'm sweating here. Cost of the asset. Out there. Remember that according to IAS 16, okay, and what? 37. So the PV of the future cost of restoration of the seabed should be added, okay, to the what? To the cost of the asset. Now, construction cost now. In the question, okay, what is the actual cost of the construction then? Is what? 30 million. Let's put here 30 million. 30 million, are you there? 30 million. Now, add now the PV, okay, of environmental what? Cost of restoration is how much there? 69. You have what? 36 what? Here you have 36. The capitalized cost. The cost of the asset now is what? 36,900. So this is what the total cost now of the asset on initial measurement. So it is what? Based on this now, you will do your what? Do your depreciation. I mean, calculation of annual depreciation. That is depreciation, okay, equals to the cost. Let's what? Residual what? Value over estimated useful what? Life. Now, what is the cost here now? This is the cost. And this is what? 900. In the question, it has what? 0 what? Residual value. What is here? Over 10 years. Out there. There you have 3 what? 36. So with this now, okay, let's see now our what? Our statement. 1. Depreciation. Depreciation now that you charge. Workings 4 is how much? 3690. Next, finance cost. The unwinding cost is how much there? 552. I mean 552. 552. Next now, the cost of the asset now is what? 36,900. Less what? Depreciation of how much? 552. Let's 552. 552. The carrying value. Okay, there it was. Is how much? 32. Sorry. Let's what? Let's 36. Okay, 3690. Let's 3690. There you are. 33210. This is what? The carrying value of the asset. Now, environmental provision now. Do you know why it is here? It is under non-current liability because it is a long-term liability. Okay, it's a what? It's a long-term provision. It's over a year. It's for 10 years. Now, what is the initial amount? Okay, you first made. That is what 6.9. I mean 6.9, right? The initial what provision plus the what finance cost. Okay, 552. How there? Now you have what? You have 7452. So this is what the closing value of the provision at the end of year 1. RDB we are asked to what do for 2 years now. Okay, the same thing. Second year I will what still have this as my what asset depreciation, but what would have been my finance cost for what second year? Okay, I will say the 8%. Out there, hello. Okay, 8% of this. Out there of this. Okay, as my what as my second year finance cost. At the end of the what second year too, I will also what add the finance cost. Okay, to the P/L as an expense, and also what also add to this one too, to get the closing value for year 2. It goes like that yearly until the actual amount, okay, is gotten out there in the what in 10 years time. In 10 years time. So this is the end of the first question. This is a standard, okay, question, okay, on what asset provision. So come here. So this is what okay, the B, okay, the BI, the BI. So let's see now the BII. Still under one view, but the BII in the next class. Let's pause. Okay, now so this is the 1BII. Okay, 1BII says that describe how your answer to BI would change if the government license does not require an environmental clean up. What are we saying here? That is, you know, under BI, okay, the government license says that we are to clean up, okay, and restore the seabed. So under BI, there was an environmental clean up, okay, cost on us. But in this case now, the license does not say so. Now, what would have been the treatment now of what we add in A? Now, because there is no requirement now, okay, for any environmental cleanup, that is, there is no obligation. According to IAS at 7, if there is no legal or constructive obligation to clean up the seabed, then Pathfinder Limited does not need to provide for clean up. Yes. So therefore, the total cost of the asset will still be what? 30 million naira. And the 30 million should be depreciated over the life of the asset. So let us see now, okay, what the change will be in the financial statement. Let's come in now. So in this case now, what is now will be now workings now will be, since there is no obligation, then there is no what need for provision. 1, the total cost of the asset will be 30 million. Now, so you are no longer adding the PV again. Now, no 2 now. Your annual depreciation now will be the cost less what? Residual value over what? The estimated what? Useful what? Life. And what is the cost here? It's just 30 million. In the question, it has what? 0 what? Scrap value over 10 years. That will be what? 3 million as your annual depreciation. So this is the only thing now, that will what? That will appear out there in the financial statement extract. So depreciation now is what? 3 million. Now the cost now of the asset now is what? Is 30 million. Less what? Less depreciation. Of how much? 3 million. That was 20 what? 7 million. The carrying value of the so this would have been in treatment when there was no requirement for environmental claim up. Now this is a standard exam question on asset related provision. This is on clean up, environmental clean up. In my next video I will show you the one for decommissioning. They both have similar treatment. It is just the issue clean up, the commissioning. They have the same treatment. So in case you like to join us, please chat us on this line 081 41 83 8062 for our WhatsApp and call. Thank you. God bless you. Love you all. Love you all. So take time, to go through the answer carefully and understand the examiner's requirements under both 1BI and 1BII. The 1A is theory, which has been dealt with in class. So see you in my next video. Thank you and God bless you.